Anyway, let's start with Frank in terms of a guide to the insurance marketplace and what's going on nowadays.
Okay, thank you, Mike. We're going to cover the following four broad categories: risk transfer and insurance products. What is insurance? What type of products are there? How are insurance programs structured? What are the principal types of policies? And then how do businesses buy insurance? Now I think that's key. Mike and Marty are litigators. They litigate over insurance claims. You might say, ask, why are there so many claims? And how does the insurance process happen? The insurance purchasing process happen? And what can you do in advance to make sure that you don't end up in litigation? So risk transfer and insurance products. Companies have risks. I think the whole talk today is about companies as opposed to individuals. So we're talking about the insurance needs of businesses. Companies have risks. They could be large risks, small risks. They could be catastrophic in their consequences. So what do you do about it? Do you just absorb it? If it's a huge loss, do you just go out of business? Well, no. Insurance developed so that you can transfer the risk. For a price, you transfer the risk to another party, an insurance company. And how does an insurance company pay that loss? Well, what they do is they aggregate the risks of thousands. Each insurer will aggregate the risks of thousands, if not millions, of companies who all pay the premium and that creates a big pool of funds out of which the few who suffer losses get paid. And one thing I just want to stress is when you are buying insurance, there's a tendency to say, we know this is going to happen to us, so we want to insure it. But that is a mistake, because the frequent small loss, if you try to insure that, everybody knows it's going to happen. Everybody knows what it's going to come to in total losses, including the insurance company. They'll happily do that for you for the cost of those losses plus a profit and an expense load. So it's just, we call it trading dollars. What you really want to think of insurance for is the big risk, the important thing that could really hurt your company. And so how are insurance programs structured? Well, if you are, let's say, a property owner with lots of real estate, several $100 million worth of real estate, possibly a single insurer will insure that for, depending on where you're located. Let's just use real estate as an example, considering what's been in the news lately, hurricanes. A single insurer might take on all, let's just say, $300 million in risk and then reinsure it. They're definitely not going to absorb the full loss themselves. If the $300 million, if there was a loss of that magnitude, no single insurer is going to absorb that. They would reinsure it. That is, buy reinsurance themselves from other insurers, reinsurance companies in the marketplace. So that's one approach. Another approach is a layered program where the insured buys layers. So the first layer could be $25 million. If a loss is 25 or under, that insurer will pay it. If it goes over 25, it moves into the second layer. So you might have it layered all the way up to $300 million. Or you might even decide, well, there's very little chance of a total loss, so we're not going to buy the full $300 million. We're going to buy a lesser amount, but it might be layered that way. One thing to be careful about is dedicated limits versus shared limits. This is both in the property area. We're going to talk about different types of insurance, property and liability. Is the insurance that you're buying dedicated to your company? That is, whatever limits you have, are they available only to cover losses that you suffer as opposed to shared limits within a pool? So as an example, what happened after Hurricane Katrina was that it got so expensive to buy dedicated coverage that pools started to be created by insurance brokers and even property managers, they got together and they created these pools where they'd aggregate huge portfolios of properties by multiple owners, put a per occurrence limit on that program, and that limit was shared. So you might have a 500 million limit against a total risk of 3 or 4 billion. So given the right loss, that limit might be exhausted. So that's a shared limits program. Sometimes you're not aware of it. It might not even be indicated on a certificate of insurance. So just to be aware that those things exist. And then in addition to the depth of the program, which is the total limit, we'll talk about the breadth of the program. That is, what kinds of different insurance are there, and what risks are they covering. Principal types of policies. We'll say the first one is called, in the insurance world, it's called first party coverage. That is between the insured and the insurance company. There's only one party involved, the insured. So it's first party coverage. And that's usually property type losses, loss of the asset, and then related to that is the loss of the income. So if you're running a business and you have a manufacturing facility, let's say, and the facility's damaged, you're going to have to replace that facility. And on what terms is part of the detail, replacement cost versus depreciated value, but that's negotiable in advance. And then you may lose income as a result of that loss if your factory is out of business. So the income, it's called business interruption insurance, or if you're a landlord, it's just called rental income, and so on. So it's the asset plus the related income. That's first party coverage. The second category is liability. That's third party coverage, where there's the insured, the insurance company, and a claimant. So your business is in operation, you're doing something, and you're exposing, you're creating loss exposures where people could get hurt, they could be injured by your professional services, they could have bodily injury, and they're going to sue you. So you have liability insurance for that. Liability insurer will assign an attorney to you. Defense costs could be included or just reimbursed. There could be a duty to defend where they will assign the attorney for you, or it could be just a reimbursement situation where you obtain your own attorney and the insurer will pay the legal fees. But so legal fees will generally covered. You want to be careful about how that's structured, and settlements and judgments would be covered up to a certain limit. Usually there's $1 million as an underlying limit, and then there's excess coverage placed over that. So you could have $1 million underlying limit and then a $5 million excess, and then it would be layered again. $5 million excess for the first 5 excess of $1 million, and then you could buy 10 excess of that, and then another 10, and it usually could go up in 5 or 10 million layers.
Frank, in your experience, does it make sense to have excess with the same carrier as the primary?
Yes, I think that's, I don't see a problem with that.
Are there
That's
fewer,
very common.
Are there
in fact,
fewer
yeah.
disputes between the primary and excess in that situation, or?
I would say so, yeah. Do you have a different opinion on that? Or?
No, I'm just
okay.
asking.
Yeah, no, I agree. And then so there's first party, third party, and other third party coverages would be D&O, directors and officers liability. So especially for public companies where you have a board, directors and officers, and they could be sued by stockholders for mismanagement of the company. They could be sued by lenders for misleading financial statements, and so on. And another category, which we'll get into a little later, employment practices liability, sexual harassment, discrimination, wrongful termination. That's in that category. And then crime and so on. A third, I would call it a hybrid, is workers' compensation. It's not property, it's not liability, it's a statutory coverage, whereby your employees are injured. There's a section on this a little later on. Your employees are injured and they do not sue you because you have immunity as an employer, but rather they collect statutory benefits. And then another thing to look at is that insurance policies have territories. General liability, for example, bodily injury occurs. Did it occur in the U.S. or in a foreign territory? If it's in the foreign territory, it may not be covered. There is international coverage which can be purchased to broaden out your coverage to worldwide operations. How do businesses buy insurance? So this is I think a key intro to what Marty and Mike will talk about. Like I say, they litigate over insurance claims. Care in purchasing the coverage can eliminate some of the litigation. So usually when you go to buy a policy, you go to an insurance broker. Agents, sometimes called agents, but brokers more commonly. And they in turn obtain proposals from various insurance companies. Sometimes they'll go through an intermediary sometimes called a wholesaler, which is just another layer to obtain the coverage. The question is, what's the duty of the broker? And I think there's a lot of misconception on this, and you should be careful about this. Generally, in most states, general rule is that they are selling you a product. Their duty is to execute your order. They're not your advisor. And you really need to know what you're buying as an insured. There are many cases on that, and of course there are always exceptions. There are exceptions to every rule like that, and every good plaintiff attorney will push those exceptions, but it's an uphill battle. So if your broker didn't advise you on a certain coverage needed, well, the broker would say, we're not your advisor. In fact, a lot of proposals that are put out today actually explicitly state that you need to know what you're buying. So, and that we're executing your order. That's their order taker defense is a common defense by insurance brokers. So it's buyer beware.
There's a tremendous amount of litigation about this against agents and brokers, where after the fact the policyholder says, why didn't you tell us that we needed product recall coverage? It wasn't covered under our commercial property policy. And the broker says you didn't ask. And it's a very tense dynamic between the broker trying to be helpful and the insured business understandably not wanting to spend extra money on its insurance, but basically being naive in terms of what coverages they actually need. So it's really important that you have an understanding at the outset what the broker's advising you on and what your expectations are, so you don't get into issues later on like that.
Right. My firm is a risk management consulting firm. We work pre-loss. We're trying to prevent the litigation that happens too often, and what we do is negotiate terms and conditions in advance at the time of purchase. And I think you should know that it's a negotiation. Of course, everything depends on how big a deal, how much premium you're bringing to the table, how big a company you are. The bigger you are, the more negotiable it is. But you do need to know that the coverage is negotiable. And it's by no means standard. There might be a standard CGL, as Mike mentioned, but there are thousands of endorsements that could be attached to it, restricting the coverage from that standard. So it is a negotiation, and the bigger the company is, the more negotiable it is. So if you're buying insurance on the basis of a 3-page proposal, you've never even seen the contract that you're going to get later, so you had no chance to negotiate it. And brokers don't necessarily presume that you want to see the full contract in advance. You should get it and be able to understand it and negotiate it. And competition drives the deal. By that I mean that a single broker who may be doing deals with the insurance company partner is not real competition. Multi-broker competition is real competition, one broker bidding against another broker. And my last point before we go back to Marty is watch out for the application. There are many traps in the insurance application. There are questions where the only choice they give you for an answer is yes or no. And a lot of times, of course, As you know, in life, well, it's not a yes and it can't be reduced to a yes or no answer. What we do is literally rewrite the question. We will, in the process of the application, if it can't be answered yes or no, we won't check either, but we'll write a narrative answer to it. Sometimes if the question says, do you always, or in every case, do you do the following, whatever it is, security procedure, we will cross off the word always, or we'll just simply, we usually do cross off the word always and then say this is our procedure, but we're not guaranteeing anything. We don't want to make any warranty statements in this application. So I just say watch out for the application, be very careful. Sometimes you're getting in trouble before the policy is even issued based on what representations you made in the application. So,
Frank, before we lose you, can you speak briefly to the kind of clients you might recommend for self-insurance, or that it may ever purchase captive insurance, how that would be different from regular insurance?
Sure. Well, so back to what is insurance? It's a pooling mechanism where you've got, if you're a smaller insured, a smaller company, with one location, you don't have any opportunity to self-insure. Your exposure base isn't big enough, so you have to transfer it to an insurance company, which then aggregates all the exposures of other companies together to create the pool. If you're big enough and dispersed enough, you have operations all around the world, and you have enough employees, enough vehicles, and they're all scattered throughout the world, well, you might not even need an insurance company. You can create your own, either through self-insurance arrangement, which is a formal process whereby all the monies that you would have paid in premiums you pay into your own pool, and sometimes that's done via a captive insurance company, which the company creates and actually owns. But there's no chance that all the exposures of your company are going to be hit by a single loss because you're so big and dispersed. So you can create your own insurance mechanism.
Which we see all the time with auto insurance, for instance. I'm sorry, auto companies. Question in the back.
Frank, do you see any benefit in purchasing multiple lines of insurance with the same carrier as opposed to using various carriers for the different lines?
The question from the audience is whether there's advantage to having all your lines of coverage with one carrier, or whether you should diversify your portfolio.
There is some advantage to creating some critical mass of premiums so that you have a little more negotiating leverage with that insurer. But on the other hand, though, if you're actually literally negotiating the coverages, it might not work out that neatly because insurer A, the one you want to aggregate most of the business with, doesn't have the right terms and conditions, so you have to go elsewhere. So it's nice if you can get it, but not at the cost of the terms.
What about in terms of coverage determinations and battles over coverage? Do you see that it's easier to get coverage when you have multiple lines with the same carrier, that you're not going to have the same level of finger pointing between carriers?
Yes. Yeah. The more mass you have, the more they want to do business with you. So there is that advantage. But don't lose sight of the terms. That's saving on the premium at the expense of poor terms and conditions will come back to bite you in a bigger way later. Yes.
I guess as a follow-up to that question, do you see any downside regarding having one insurer doing multiple lines where they have an inherent conflict of interest and they limit payouts in order to maximize the terms of one policy, maybe to the detriment of another that might have better coverage?
The question was whether if you do have all your eggs in one basket, if you will, does that create a conflict of interest where the insurer tries to maximize or shunt the loss to one policy to the exclusion of others?
Which might not have as favorable terms.
Which might not have as favorable terms.
Well, I actually see it working the opposite way, which is that if you have two different insurers on risks where there's a gray area, as this policy could be in, they're pointing fingers and then these guys are litigating over it. Whereas if you have the same insurer, it doesn't matter which way it goes, they're going to have to pay it. So you're more likely to get coverage. Any opinions on that?
I think that's been the trend in the industries. I mean, I do a lot of construction litigation, and there's been any number of disputes over the years about additional insured rights between the owner and the architect and the contractor and the subcontractor and the minority subcontractor and the truck driver. And what's evolved over the years recently is something called Owners Controlled Insurance Program, OSIP, or variants of that. The idea there is you have one policy that covers the entire project. So you eliminate most of the points of friction that previously existed among the different insurers, try to shunt either legal liability or coverage liability between each other. The danger is that you lose some of the leverage that Frank was talking about. For the last couple of years, the insurance industry has been in what's called the soft market. Now, it may be hardening with all the craziness that's going on now with hurricanes and fires, but at least in the property market. But insurers have been frantic for premium lately, and no one's making money investing, in bonds. So it's all about underwriting, and there's a lot more incentive on the part of insurers to get premium now by, writing coverage. So it is very much a buyer's market for policyholders compared to, say, 10, 15 years ago. Great.
Marty?
Thank you, Frank.
Thank you.